You're listening to AI Prism from Seoul Economic Daily.
If you're holding Samsung Electronics or SK Hynix, yesterday's rally added real value to your portfolio. Korea's KOSPI just posted its best day in weeks, and foreign money is finally coming back. But if you're holding yen-linked ETFs, the story is the opposite. Losses keep piling up. And Korea's bond market is flashing a separate warning sign that could affect fixed income holdings. It's Thursday, August 13th. Let's look at what this means for retail investors in Korea. Korea's stock market spent much of this year swinging wildly, with intraday volatility that topped 7% during last month's sell-off. That volatility scared off both leveraged retail traders and foreign institutions, dragging the index well below its highs. Now, credit unwinding is largely finished, market breadth has improved, and a stabilizing $1 rate is drawing foreign buyers back in. Here's what the numbers show. Korea's benchmark index closed at 6,579.04 on August 12th, up 3.68%, its third straight daily gain, as a buy-side sidecar triggered mid-session for the first time since August 5th. Samsung Electronics jumped 6.68%, and SK Hynix climbed 5.54%, settling near 250,000 won and 1.5 million won, respectively. Foreign investors bought a net 2.84 trillion won, roughly $2 billion of Korean shares on August 12th, extending a second straight day of net buying. 56.49, the closing level for the KOSPI fear gauge that day, is its lowest close since May and down 41.73% from June's peak of 96.94. The weaker yen kept dragging on yen-linked ETFs. Tiger, Japan yen futures fell 4.47% over the past month as the won-yen rate broke below 900 won per 100 yen. Elevated corporate bond yields, with the 3-year AA- rate hitting 4.651% last month, a near 3-year high, cut large company bond issuance 32% year-on-year to a 4-year low, a sign credit market stress hasn't fully cleared even as stocks rally. So what does this mean for retail investors in Korea? Earlier, we said the KOSPI rally means real gains if you're holding Samsung or SK Hynix. Here's what that actually means for you. 2 straight days of foreign net buying suggest this bounce now has genuine institutional support, not just a one-day pop. If you're holding yen-linked ETFs, the losses aren't over yet, since the won-yen rate keeps breaking lower and the Bank of Japan is now expected to hike sooner than previously planned. And the credit market stress behind slumping corporate bond issuance is worth watching even without direct bond exposure, since it shows how much higher borrowing costs are squeezing corporate Korea. Here's what to watch. First, September's FOMC meeting, where futures markets currently see a rate hold versus a hike at nearly a coin flip probability. Second, whether foreign net buying extends to a third straight session, which would strengthen the case that this rally has real legs. Third, the Bank of Korea's rate decision and Korea's 2027 budget announcement later this month, both flagged as key catalysts for the corporate bond market. That's today's AI Prism, Retail Investors. This episode was produced with AI assistance based on Seoul Economic Daily reporting and reviewed by a human editor. AI Prism is a WAN-IFRA award-winning series. We'll be back tomorrow.
You've been listening to AI Prism from Seoul Economic Daily.